All right. Good evening, Bryce. Thank you for taking the time this evening for talking about a topic that we have yet to be able to discuss on this podcast, and that's hard money lending. If you could please tell us a little bit about yourself.
Well, everything I've done is pretty much been surrounding sports. I grew up playing ball for 20 years, football. Got some jerseys and memorabilia behind me, but I'll be the first to tell you I'm about as washed up as it gets. So, but the discipline, the teamwork, hard work ethic, all that's just pretty much ingrained in my DNA from playing 20 consecutive years of football. So it translates seamlessly to this real estate world, and I lean on it heavily. Just to accomplish the task at hand each day in and out for what I do. Currently just being a provider for my family and trying to help out with the community. I train athletes, train pro athletes, and just try to stay as busy as possible, and then keep delivering for my borrowers and investors in the real estate investor world. So a father of 3 little girls, people eat that up, big fat football player now these days, but they see me toting around 3 little girls, so they love it. And that's being a girl dad is probably the best title that I've got.
And so what got you into real estate?
Well, I was in a position where it was salary based, and I've got a stepdaughter. She's 10 now. I've got 2 little girls. One's 2, the other one's 1. And, once I hung up my football cleats, it was just kind of like figuring out a place in this world, in corporate America, and basically taking, that same tenacity and that relentless spirit and trying to translate it to the workplace. And I won't mention any names or who I worked for, but it was a salaried position to where no matter how hard I worked, there was that ceiling there, and there was just something missing for me, as far as the drive and motivation. I delivered on customer service. I was one of the best, reps at what I did. It was in the insurance world. And ironically, I was, the last position I had before being in real estate was as an insurance claims adjuster. So I was dealing with injuries, and being a guy who was an offensive lineman and played ball for 20 years, I was somebody that I just didn't speak of it. You didn't talk about injuries. You didn't talk about pain, this and that. So here I was in a position where every single phone call I got was, somebody in a bad car accident or what have you. And it was literally probably, one of the most traumatic points in their life. So it was never a phone call where people were calling to thank you or just say hello. It was always just a stress time. And then how could I work backwards to resolve, those issues for those folks. And, so it was pretty taxing emotionally, mentally for me. But it taught me so much about customer service. And if I could do it all over again, I wouldn't change anything, because God's timing is perfect and his plan was good. And basically I got to a point where what I was doing, I knew I couldn't provide for my family, but I never quit anything in my life. So I didn't know, I felt kind of trapped. And I was like, coming home, I was developing anxiety, all this stuff. You're when you're an elite athlete, you feel invincible. And then all of a sudden you're, driving to work, and you get to that one exit, and every morning you're getting this rush of anxiety, and you're like, what's wrong with me? What's going on? And, I just realized I wasn't in the right place for what I needed to do, and then be comfortable with providing for my family. So eventually just sat down with, some of the leadership team there and let them know. And they were kind of like, well, yeah, we knew, we were waiting, but we weren't going to encourage you to quit and go do something else. But we knew you were, for lack of better terms, I guess, overqualified, but just really not tapping into my potential. And I kind of knew it too. But like I said, I had never quit anything. So basically was at a youth football camp that I ran, and still cannot get away from the game. So I just try to, use that platform as much as possible, because that's my therapy, just being involved with football and around it. I know it like the back of my hand. And one of my buddies, he was wholesaling with HouseMax and on their real estate side. And he said, hey, the owners at a HouseMax, they're doing some financing now. Institutionally, our company, our principal owners have probably flipped over 2,500 homes themselves, and they were just tired of getting hosed at the 12 to 15% rates, the old school hard money stuff where they just try to take your head off. So They started this company themselves with their own money and their own investments and their own capital partners, and raising the funds needed and basically undercutting the market to give cheaper money to borrowers and not try to get fat off of one deal, but keep them coming back for more. So my buddy was explaining this to me and I'm like, dude, I don't know anything about real estate, finances. I can't tell you how many concussions I've had. I need a calculator. He's like, don't worry about it. These guys are, one of the owners, both of them are former athletes, but just kind of, pulled in and sat down with them and told them, hey, I've got no real estate experience, but I do know how to work my tail off. And I'm ready to start when you guys need me. So basically just, another, fellow football buddy of mine let me know what was going on and took the leap of faith because what I was doing, prior wasn't getting the job done. So again, a little divine interaction there with leading me to where I'm at now, because it's really been life-changing for me I've been with HouseMax for just, little over a year and a half, and some, what I'm originating and what my team has been able to help me accomplish here. And, the owners and our VP and other, senior loan originators who I've leaned on heavily, man, we just really accomplished a lot in the last year. And, I was number one all through last year. And then the first, 3 or 4 months of this year. And it's, there's really no secret to it. It's just kind of putting your head down and going to work.
And so you got exposed to real estate through wholesaling. How did you get transitioned to being a hard money lender?
So my buddy who introduced me to it, he was on the wholesale side and basically said, hey, the owners are starting a financing side and they're looking for some other guys. And he knew how hard I was working and how stressed I was about not being able to provide for my family. So just took the leap of faith and like it just showed up, man, just looking for another opportunity, really. And I really can't explain anything else other than the fact that it was all part of God's plan, and the timing again was perfect. So yeah, he was a wholesaler, but HouseMax had their real estate side with wholesaling, and then they were starting this new financing company, and they were just looking for some originators. And like I said, I came in, sat down, and I said, basically, when can I start? I'm ready to go. They explained, 100% commission. You eat what you kill, and those words really resonated with me because it just reminded me of sports, right? You prepare week in and week out to get that the win for the week, and basically with hard money. You can close in 7 to 10 days, even sooner if you need to. So, I was just, some of those things they were saying were tapping into everything that I'd done in the sports world, and the thrills of the ups and the downs and the excitement of getting the win and then being able to come back after a loss, or I say loss, but man, there really hasn't been a deal that I said that we were going to fund that we didn't fund, so that's another thing of mine is, what we say and what we do has got to be the same.
And so it sounds like your dynamic is a bit different. So it sounds like, because I've never heard of commission for a hard money lender. So when it comes to you working for this group and you being part of the financing, where's the money coming from? And then how does it work with you getting your commission?
So the funds that we use to fund these deals, or the capital that we use they're a combination of, our owners, even myself, being able to invest, my paychecks back into the company, or bringing on other investors who've got some money sitting around, linking up with other banks, other capital partners, other hedge fund guys that see how we work and how we do our due diligence on these deals, and basically minimize, the risk factor into it, and make sure we're just pushing out good products and funding good deals, and then getting returns on those notes, while the borrowers are fixing and flipping, or they're buying and holding, or they're doing ground up construction. So yeah.
Okay. And so please explain, why would somebody want to go with a hard money lender versus going through a traditional loan lender, like through a bank?
Yeah. So there's a few variables that come into play, and I will be the first to tell my borrowers, if you can get cheaper money, if you can get bank money, go for it. Okay, because there's going to be a point in time when you can't. So a traditional lender is going to cap you at a certain amount of loans. It's usually around 10, okay, with Fannie or the Freddie route. So they're going to cap you at 10. They're going to report those loans to the credit bureau, so it could potentially impact your personal debt to income ratio. And if you want to make any personal purchases, what have you, on your homes or this and that, get lines of credit, going through a bank, it's going to have an impact on that. We're significantly less docs. We move faster, but this market has really been indicative of what investors can do and how they can utilize hard money. And then folks who have never used it before, we're not licensed to fund any primary residences, but basically you've got a market to where, people need to close quick. Basically hard money will level the playing field between cash buyers and financing, because we can close so quick, with an option period of 7 days or what have you. Whereas the bank, you're not going to find a bank that's going to be able to fund you in 7 to 10 days, right? It's going to be 30, 45 days. They're going to need your right arm and your firstborn and documentation. So, but if you have the luxury of being able to wait and you're approved for a bank loan or what have you, and maybe it's at a 3% rate, and it fits better. I say math is math at the end of the day to a lot of investors. Then, like I said, I encourage my borrowers to go for it all day. And then basically once you're capped, once you realize you can't move as fast as you need to, once you realize that it's just a hassle to overturn that many docs, leverage and velocity is key in the investor world. And if you're just, banks are great for other means or different markets to where you don't have to move as fast, or you need, a primary residence and you can wait 45 to 60 days. But, we don't have that type of time frame here in the investment industry.
And so when it comes to, you mentioned how the banks have their, let's say their 10 property limit. When it comes to hard money lending through y'all or through any, maybe generally speaking for hard money lending companies, do you have a limit on how many times somebody could use y'all as a hard money lender, like
Nope.
at the same time? Like if I want to do 10 deals at the same time, boom, y'all fund me.
Let's go. That's what we want to do. That's what we're here for. So basically, so long as you can afford your skin in the game, then we're good to go. Our money is your money. We've got the capital, you find the deals. So if you've got enough, liquidity to basically, and we can get into discussing some of the different tiers, but 25% down, 20% down, all the way down to 10% down. We're not one of those shops that'll fund 100%. We feel that there's value in having some skin in the game, and it creates a sense of urgency. But
Yes.
basically, yeah, our capital is we've got a lot of it. We've raised a lot, and we haven't run out of it. If we did, it was an excellent month. No one would be mad. No one in this shop would be mad.
What do you think? What about your company keeps y'all competitive? Is it y'all interest rates? Is it customer service, follow up? What do you think will what is somebody looking for in a hard money lender outside of obviously their money to say, hey, I want to keep coming back to them?
Well, with us, they're immediately going to see that, our rates and our terms and our points and what have you are probably the best in the industry. There's some other big, we're still, I refer to us as a small mom and pop shop, which is a good thing, because there's other lenders that, 10 years ago were like us, but now there's such a big shop, you don't get that VIP feel. My owner sits 2 doors down from me, and if there's ever an issue or we've got to stick our neck out for somebody, I walk 2 doors down and knock on his door and let him know what's going on. But basically what sets us apart is the pricing. We say our cash is just as green as everybody else's, but it's just cheaper. And then basically you're getting the value of a relentless, I'll speak for myself, but I also know the rest of the team. We are relentless in our pursuit to do what we say we're going to do and make sure we fund these deals, because ultimately that's what, puts dinner on the table, puts food on the table for my family. So value in the price point. I'll preach those to the cows come home all day.
And so what type of real estate funding does a hard money lender provide? So we talked about possibly trying to buy a house in cash and then renovated. Is there any other type of archetype that y'all assist with it as well when it comes to funding?
Yeah, so the property type, we like to stick to single family residence up to 4 units. We can move into that multifamily space if we come across those deals. No problem. We fund those often. But I like to stick to that's, hamburger and hot dogs is what I call them. Single family residence up to 4 units. We can do a bridge loan, and the bridge loan is just going to be a 12-month term. Out of that bridge loan, we can do an outright purchase, and or we can do a purchase plus renovation. And that bridge loan, it's usually a 12-month term, interest only payments. There's no exit fees or prepayment penalties. So basically you get in and out of it whenever you need to, so long as whatever your exit strategy is. We specialize, I say probably about 4 areas: the fix and flips, the buy and holds with rentals, ground up construction, and short-term rentals, so Airbnbs.
And so for some people that don't know, a couple of exit strategies that they can use is some people use that opportunity to refinance their home. They do a cash out refinance. That way they would pay themselves back and the hard money lender, or they could just straight up sell the house and cash out. But you got to pay capital gains tax on that, unless for the fancy people, you want to do a 1031 exchange, and that's a whole different ball game. I'll make sure I put a link in the description of what that 1031 means. But there are a few exit strategies. I know that some people 12 months to try to figure something out. I owe probably $100,000. How am I going to make this work? But there are a lot of ways to make that work. People would be surprised how quick they can rinse money, hundreds of thousands of dollars, and keep rinsing it and keep making building more capital and building more worth.
Yeah, you make an excellent point, man. You're basically you're borrowing our money to make money for yourself, so with something, a 12-month term, again, it's usually you want to have that strategy in place. Anthony, you're going into it, you're going to purchase it, you're going to renovate it. Ideally, you probably, if you've sized it up, it's got enough meat on its bones to work as a flip. You're hoping to be in and out of it within maybe 3 to 6 months, but in the event of COVID rolls through, right, and things tank a little bit, or now all of a sudden you're not able to get some wood or materials, and that drags out, well, then you got to be cognizant of your evaluations of basically your cash to cash, and how much profit is there. And again, I say meat on the bones for the property. And basically, if you had to go that full 12 months, which we don't ever want our borrowers to do, but it's there. And at the end of those 12 months, you can either extend, so long as you're a good borrower, or the note balloons, and it's owed in full. And usually the way to get out of that is to refi into something maybe long-term, or just refi again into another 12-month term, or sell the property, right, and collect your profits, or pay off that note. And then, the other terms are for long-term rentals. We've got a 30-year loan product that's basically mimics everything that people know about the conventional world.
Okay, awesome.
Yeah, so we've got a 30-year product too, with rates in the 4 to 5% range. And it's exactly what you get from a bank. And what's great now for us is that Fannie has increased their LLPAs, which is the loan level pricing adjustments on investments. And, they found those to be more risky right now. So those prices are going up. So, borrowers that I had were maybe that want to follow the Burr model of buying and renovating, refinancing and repeating that process, are basically were using us to fund the purchase plus reno to add value. And then they were going through a bank to get that long-term 30-year program. Now, some of my borrowers are calling me back after they finish their renovations, and they're saying, "Hey, man, the bank's quoting me in the 5% range. What are you guys doing?" I'm like, "Dude, we can do 4.25 all day." And they're like, "You don't need any W-2s. You don't need tax returns, this and that." And I'm like, "No, we need 1 month of your most recent bank statement. We can close it as an individual, or we can close as an LLC." And so long as we're the hard money, the term hard is basically referring to the hard asset, right? Like, so we're primarily asset based, but there's a lot that we do as far as making sure that the borrowers are having a decent credit score. We go as low as 620, but some of those are just how we manage our risk, right? And If the borrower's got decent credit score, okay, they've been making timely payments, or maybe they're not maxing, they're not utilizing all their credit, so they've got some avenues in case crap hits the fan to get the job done. But other than that, yeah, we're pretty much based on that hard asset, and when that appraisal comes back, and math is math at the end of the day, and if everything's in line and those numbers hold true, then we're going to fund it for you. And if not, we're not going to push anything through and shoot yourself in the foot, because at the end of the day, we need to be successful, and for us to be successful is lending our money and getting that money back. Yeah. Right. It does no good for us. There's some programs out there, and that it seems like they're kind of in the business to loan to own, because be aware of it. There's a business side to that too. I fund a deal for you, and I push it through and realize you don't have enough liquidity, but I'm like, hey, it's okay, we're a mortgagee on it. If Anthony can't get the job done, then HouseMax will move in and we'll sell it, and we'll collect his profits basically and push you aside, but we don't have time for that. We're not in the industry to do that. We don't want to do that. But there are some out there, that's so, yeah. And it stinks when it happens, but it's just something to be aware of.
That's awesome. Y'all provide your own exit strategies for your customers. I've never heard of a lending company do that. I've been on the phone with several hard money lenders, and that's never been something that was presented to me as, hey, I've heard the 12 months, right? And then, hey, if you're really good at communicating, you're showing progress, they'll give you an extension, but never, hey, we'll put out a 30-year mortgage for you. And I guess because they want to keep up with the quick, rinse and repeat of their money. But yeah. I think that's an awesome way. I'm not sure what the business structure has to be and able to do that type of 30-year commitment, and it still not hurt your capital that you had to push out initially for that deal. But I could see myself just wanting to do business strictly with you. I don't need to go to the bank, if I can get hard money lender from you and a mortgage.
Exactly. Right. On anything that's a non-owner occupant deal. So yeah, it's worked great for us. And basically what we do for our borrowers, if we're going to do business on the front end, the purchase plus renovation side, then when we refinance into that long-term deal, we'll streamline you into it at no points charge, because again, if I can keep more of my borrowers cash in their pocket, the more chance they have to come back and do more deals. And ultimately that's what I've got. And we've got a term, in this industry is pigs get fat and hogs get slaughtered. So I'm just trying to get fat, man. I mean, I'm there physically right now, but just taking care of bars and keeping them coming back. I'd rather do 10 deals with you as opposed to one, and see you struggling and not I take joy in being a little bit a part of, your success or the other investor success or what have you. And I keep saying you, but obviously I'm referring to you in the sense that if you were a borrower of mine, that's how we treat you and get you taken care of.
Do you provide services outside of the state of Texas? So if I was in North Carolina, hey, Bryce, I heard you do good business. Okay.
Yeah, we lend nationwide with the exception right now of Arizona, Nevada, South Dakota, North Dakota, maybe Alaska. And basically, I want to say Arizona, their lending requirements in Nevada may require us to have a storefront there or brick and mortar in order to be eligible to lend. So I think that's why we don't lend in those states, but we're working on it. We've got some boots in the ground to continue to grow. And then South Dakota, North Dakota, we're not going to find anything that's rural, because if you think about it, you get something that's on 50 acres of land, that's a certain niche of borrower or investor that's going to come out there and buy that, right? And that could be sitting on the market for a long time in order for you to find somebody to buy that. And guess what? While that property is sitting there, you've got your interest only payments that you're paying back for borrowing my money. So that goes into your overhead or your costs, and that's chipping away at your profits. So yeah, really, man, anything that's on that bridge product is really a bridge. We want to get you from point A to point B as fast as possible. And that's the ultimate objective of it. And then if you find out that once you get into something that, hey, maybe I want to hold on to this long-term, then we do have that option to refinance into that long-term product at no additional points charged.
And so does it also work to where somebody could refinance? Let's say they already have a mortgage with, say, penny match. can they refinance with y'all from somebody else, from somebody that already owns the mortgage?
Yeah, absolutely. So when we refinance a loan, you want to make sure that the payoff can be covered by, you know, our leverage that we're going to extend to you. So for a rate and term refinance, the max we can lend is about 80% LTV, loan to value. So
Y'all do 80%?
yeah. You're getting excited. I see it. You just want to, let's end the show. You're going to find some deals or go back to those deals that you've already passed up on.
Everybody that I call is 70%, man.
Exactly.
Everybody.
My owners, man, they've worked their tail off to really put us in this position. And that's when we started this conversation, man. It wasn't about real estate. It wasn't about this industry. I didn't know what hard money was. I didn't know what I was even getting into. All I knew is, well, I wanted to get away from what I was doing before. And then I just believed in the team here. And then I found out, holy smokes, I really, you know, real estate is awesome. And then once you dive into it, you see how many other moving parts there are in opportunities and to invest, to work, you know, title companies, appraisers, contractors, inspectors, architects, engineers, realtors, lenders, private lenders, hard money lenders. There's probably 500 more you could name that you know, the real estate industry gives that opportunity to people. But yeah, the team here at HouseMax was really what I kind of clung to, and then it just turned out I really enjoyed this space. So yeah, they've worked their tail off to be able to extend, you know, cheaper money, because we have to have either, we've got to have it, or we've got to have the connections and other capital partners or investors that trust us to use it, and basically trust us to use it at a lower rate than, you know, what somebody else would. So it's a lot of networking. It's a lot of relationships based, man, stuff that goes on behind the scenes that some people don't understand. And they're just like, you know, I see a lot of posts for, you know, and there's nothing wrong with it. I don't want to, you know, make it sound bad, but you get these posts or these borrowers sometimes that are like, you know, I've got terrible credit, I've got no money, but I want 100% finance. And so if that was you, if I'm coming to you, Anthony, and telling you all that, you know, what in your mind makes you want to give me any of that money? You know, what you got to sell yourself too. So for my borrowers, sometimes I tell them, man, do whatever it takes to get that credit score up a little bit, because in your lender's eyes, it's going to be, okay, they're committed to working on this, you know, or do, you know, make those commitments to save a little bit more so that you've got some of those reserves that you can lean on. So, because we're so risk management based, you know, and it's basically my job to mitigate as much risk as possible for the money that I'm using and working with, because the more I can do that, the more we can just keep getting good returns on it, keep recycling it, keep growing, and keep helping more and more folks. So that's kind of the name of the game.
And so when it comes to hard money lending, can somebody be pre-qualified for that?
Yes, the pre-qualification or the pre-approval process is, with us, is your credit score 620 or greater. On your background, do you have any recent bankruptcies, felonies, or liens that exceed 15,000? No? You got a 650 credit score, guess what? You're approved. It's that simple. You know, from there, we want to break down the asset. You know, now we want to take a look at the asset and say, okay, because basically that's the collateral that you know, we're using and guaranteeing that is basically a way out for us. Like I was saying earlier, if you know, we use the hit by a bus rule, if our borrower was to get hit by a bus after the day we fund it, is there still enough meat on its bones, or is there still a way that this deal works to where we can unload it and make sure that we get our money back? So yeah.
Okay. And so when it comes to, because I mean, you mentioned earlier, you don't do 100%, which is, I agree. I know some people that do, but I respect it when hard money lenders would tell me, hey, I need you to put in just like I'm gonna put in, and then we'll work together. And what I noticed the difference is, if we both got in, or if we both go in, there's more of a it's more collaborative.
Exactly, man. You hit the nail on the head. And it's refreshing to hear, because it's a team. It's a team, right? And it's a business relationship. And the last thing you want is somebody that just feels like they're being used and not, having the partner, if you will, kind of hold their weight. And, we were able to survive through COVID. And that's kind of one of the major things that really gave us a leg up on the industry when COVID hit, man. A lot of lenders were selling their business if they could. They were throwing in the towel, they quit, or they just shut down their whole program, where, we did not over leverage our borrowers. So we were still able to provide them with the construction funds to keep them moving. Whereas some other lenders, they were so over levered that they didn't have any money left when COVID came through and no other deals to come through to bring in origination or what have you. And now they've got their borrowers calling them up saying, hey man, I need a draw for 20,000 to finish up this rehab so that I can sell this and get you your money back. And they're like, we don't have it right now. So that's kind of what you get yourself into when you over leverage. And then, like you said, it creates that dynamic to where, there's a sense of ownership too. And when you've got a little bit of your skin in the game, that gives you that sense of urgency to, yeah, man, this is, I've got my hard cash in there too, that I've worked hard to get. And, I want to make sure I make a successful exit. So, and then again, the larger the loan amount, the more that you're going to be paying monthly anyway, right? So the more skin in the game, right? The more skin in the game that you can have, then the lower that, total loan amount is going to be, and you're paying less on it. And really, to get 100% financing, man, the lenders are at the 12 to 15% rate anyway, and they're going to be charging 4 or 5 points because they know nobody else out there is doing it.
Yes.
And I mentioned it, and I don't want to kind of generalize a lot of lenders, but that's kind of that loan to own, predatory type lending. You feel like there's plenty of good ones and great scenarios, and maybe people that, and there have been times when we have done it before for our VIP borrowers or who are just deal rich but cash poor. You've got 10 deals going on right now. You call me up, Bryce, another one came through the pipeline. I'm going to crush it. We've done this amount of work together. You've seen, the 500K I've had in my bank account a couple of months ago. Right now, I just, could use a little help. What do you say? Let's size this one up. And there's scenarios like that where it makes sense, for people that we have built that relationship with. And again, that goes back to the team at HouseMax and what we can do in relation to a bank or a conventional lenders. We can stick our neck out there for you or get flexible when push comes to shove if needed, because at the end of the day, it's our money.
No, you're right. And I think you got a customer. That's why when you told LTV, I was like 80%. Okay.
Right.
So one thing that I've noticed in this, and this is a little bit off, but I think this is something that people need to hear when it comes to business in general, not even just real estate. Good customer service. You act like you care, right? Care about them. And then you providing opportunities, right? So one thing is, let's just say I provide a service. Now, how in that service can I provide maybe sub-services that keeps the retention of those customers? And so that's what y'all been able to do to ensure it's not just a one transaction deal. Outside of that one, you came to me for one thing, but now I can service you in these 3, 4, 5 other things.
Exactly.
And so I think that's what I really like about your business and what y'all do. And it's a great business strategy in anything, not even just real estate, but we just so happen to be talking about real estate, but definitely something to think about. Anybody that's an entrepreneur, you want to think about customer retention. And one thing I noticed in the real estate game, customer service is garbage. If
Right.
People would be so much better, whether they're a real estate agent, property manager, contractor, they would be so much better if they would just pick up the phone and call back. They would be killing the competition.
Text, call back, do anything, right? And I recently, how busy we've been. That's something that's kind of been on my mind because I take pride in that, being able to follow up on time because, this is a high performance industry, and just like sports and, my career as an athlete, again, it's critical moments, and you're dealing with other people's livelihoods and basically them being able to provide for their family. So I cannot tell you how many times that on a Saturday or Sunday when my phone rings and I pick it up and I hear a borrower just, light up and say, Bryce, I had 20 lenders written down. you were the 10th person that I called and you were the first one to pick up. I don't even care what your rates and terms are. Let's do business together.
Yeah.
I'm like,
Yes.
sir, Mr. Smith, I'm sorry, that's the way that the competition is, but I'll take it. And that is so true, man. And it's just,
I've been there too.
Right. And if you can't answer, man, just some sort of communication. And then even having that ownership. There's been plenty of times, when I've been involved with some other stuff or training athletes, and my phone's just blowing up. Maybe a borrower needs a pre-approval letter or whatever and I step aside and I let them know, hey man, I'm at this event right now. And they totally understand. They're like, dude, you've got to have a personal life too. Get to it when you can. So I think people appreciate being honest to a fault and transparency and no BS answers in this industry, because there's a lot of fluff. There's a lot of over promising and under delivering. But I think the more, if the borrower that I get that, maybe needs just 5K more in money for us to feel safe with what they're doing and know that pushing a loan through that could potentially hurt them for the long run, we're going to call it off. We're going to say, hey, let's wait 2 or 3 months to raise a little bit more money for you. You can crowd fund, you can call up your rich uncle, see what money you can raise, this and that, so that you're in a better position, and like you said, we just want to add value. And that's a great business model for anybody. What you give will grow, what you keep, you will lose. What can you give? What can I give to help my borrowers be successful? Whether it's my time or whether it's just a little bit of information or first time flippers. I'm on a Facebook group with first time flippers and they're asking questions and 9 out of 10 of them aren't ready. 9 out of 10 of them don't have any money, but guess what? You keep planting and you keep watering those seeds. And I get calls back 6, 8, 12 months down the road and they say, hey, Bryce, remember when we discussed, this hard money 6 months ago? Well, I've saved this amount of money and I've got a deal that I'm looking at. Can we size it up? I think I'm ready to go. And we do, and it's an awesome feeling for myself and for those borrowers to kind of put those, checkpoints in place and then knock them off one by one. Because if it was easy, man, everybody would be doing it, but there's some strategic patience to it as well.
I noticed that you provide different packages. If I heard you correctly, you was talking about 50%, 25%, 10% skin in the game from the borrower. Was that correct? Or y'all just have a flat rate of what?
Well, no. So yeah. So for, we can get into several kind of different loan structures, but basically for a bridge loan, right? Getting you bridge loan, you want to think of getting from point A to point B pretty quickly, right? And out of a bridge, and we can close those quickly. Those are, 4, 7, 10-day type close. So for an outright purchase of a property, you call me up, Bryce, I got to close in 7 days. This one's turnkey ready. I don't have time to fund it 35, 40 days, what have you, with the bank. But I want to take it down quickly. So for those, basically the magic number is 75% LTV, loan to value. Okay. For us, because we feel like that's kind of the ballpark number on the market. Again, if we were to have to move in and help and unload the property or sell it to keep you whole or to prevent a foreclosure, that's kind of where we want to be, and we can make it happen and not lose too much of our money, right? So an outright purchase, something that we would call already stabilized, would be 25% down. Okay, something that is unstable, basically meaning it's a distressed property that you're going to add renovations to and add value to ultimately get us to that ARV, which is the after repair value, is going to be anywhere from 20% to 10% down, just depending on the borrower's experience. Okay, so yeah, we're really, I would say 90% of the time we're never really going to require more than 25% down on a purchase. And if you're going to structure it to where you're going to add value and you're going to yield this product that's going to get you a good after repair value, then we want to help as much as possible, because it's just going to make the community better. You're adding value, right? So it's not like you're just purchasing a property that's you can't do anything to, or it's already good to go. So we can increase the leverage. We'll fund 100% of the renovations, and we'll keep you moving. Yeah. So, I mean, if you were to ever pay 50% down, man, that would just probably mean, I don't know, maybe, maybe your credit score wasn't too hot or something like that, but you've got all this money in the bank and we're like, okay, let's do it. There's been kind of one-offs, and I don't like to, fit square pegs into round holes, but maybe a land takedown, that you're eventually going to build new construction on, or maybe wholesale it and kind of get rid of it quickly. But you want to keep as much cash in your pocket as possible, and just for when those other deals come through the pipeline. So yeah, I would, at 25 to, we'll range from 10 to 25% if for the most part.
And that 10 to 25% is of 10 to 25% of what the house is worth, or what?
Of the LTC, so loan to cost with purchases. Okay, yeah. So the cost is going to be the purchase price. So there are some folks out there that'll, LTV, the loan to value, or anything that you're going to lend against the value, is really kind of comes into play when you're looking at a refinance. Okay, so the LTC will lend 25 to the down payment is always going to be on the purchase price.
Okay, copy, gotcha. And so from the beginning, I want to start, and we'll kind of go through the process. So I come to you, I say, hey, Bryce, I need this deal. How do I present this deal to you? What am I providing to you outside of my credit score and stuff like that? What about the deal am I presenting to you?
Yeah, I'll pull it up right here. I've kind of got my elite 8, if you will, kind of steps to what I want to follow. And basically, like you said, I go through that pre-approval process real quick, kind of what's your ballpark credit, background good. And then I want to know your experience. How many deals have you done? I want to know who I'm working with. What type of exit strategy are you most familiar with? Because then when I'm having that conversation, it's kind of painting a picture for me on how risky it is to work with this borrower. Okay, somebody who doesn't have that much experience is going to be a little bit more risky, so I'm going to want more skin in the game. Okay, and somebody who's maybe done this plenty of times, okay, we can extend more leverage. So I want to hear, basically your experience, and then from your experience, okay, now tell me about the deal. Tell me about this asset. Where is it located? Is it in a major market, or is it kind of on the outskirts, or is it in, who knows, New Mexico or what have you? And again, that goes back to how long it's going to sit on the market, right? So we want kind of these major market areas, nothing rural, that's going to take forever for you to unload it. We want to know what type of property is it? Is it a single family residence? Is it a duplex? Is it a condo? Is it a trio? Is it a townhome? Is it a quad? Because again, we kind of, break those down into kind of different levels of risk management there. And then what's the purchase price? Are we getting it for, what we think it's currently valued at? Are we getting a great deal? Are we getting it under the market value, which is always great, right? And what we're seeing right now in this market is people are overpaying, right, for these properties. But on the back end, when they sell after the renovations, they're making more for it. So yeah, there's
it works out.
Yeah, exactly. It all works out in the wash. Yeah, so basically looking at that asset, what market is it in? What's the purchase price? How good of a deal is it? How much in renovations do we need to add to it in order to get it up to par with some of those other comps in the area that are going to yield us that good after repair value that's going to make it profitable? And kind of the magic number when I size it up in our calculations, for experienced borrowers, we'll fund stuff that's 10% plus profitability kind of after, some of the other, maybe there's realtor fees or holding costs or what have you. But ultimately, yeah, I mean, you probably don't want to be doing anything less than 15%, unless you just got a crew of contractors that you need to keep moving and what have you. So basically after that pre-approval process, I want to hear your experience. Then I want to see let's talk about the asset info, what property type, where's it located? What's the current market value? What's the purchase price that we're buying it at? What's the renovation budget? And then what's that estimated after repair value? Okay, then once I kind of got that picture of your experience, now the asset, now we can discuss our leverage in terms, right? Now we can do, okay, your experience, we're going to fund 90% of the purchase price and 100% of the renovations for you, right? Because you've got a proven track record of successful exits. And for those types of borrowers, we just want to keep them liquid and get them on board with us, and get those repeat customers. So.
And so you mentioned about paying points each month, paying on the interest each month until they find an exit. How is that? Is it the people say points and they say interest rate? How are they the same but kind of different?
So points is just another word for percentage, right? Because then we've got, you see percentage so often, God forbid we use it again, right? We just got to get creative to make things more challenging. Why not just keep it all the same? So points is just another thing for percentage, and it may also be referred to as bips. Points can be referred to as bips. So 250 bips would be 2.5% in our world, but we don't have to go down that rabbit hole. But basically, so there's an origination, kind of just, if I could explain, it would be similar to you paying a realtor, their fee for going to work for you for marketing or doing the research, and basically the amount of studying and education that they have and knowledge on the subject. You're trusting them to just kind of create a better scenario for you. And so when we originate deals, a portion of my commission is paid from me originating those, right? Spending the time on it, doing my due diligence, making sure to collect those docs, all that. So points, aka origination, that's paid at close. Okay. And that can range from 0 to 3. To be honest, in a 0 point scenario or 0 origination fee would be something like on our long-term product, to where we did business on the front end. But anyway, okay. So you'll pay points at close. Okay, that's going to cover basically the LO, the loan officer. Keep the lights on at the lender, at the company that you're working with. Help them pay for their overheads, this and that, and their research for you. Their experience, their expertise, and then basically the monthly interest only payments is basically your holding costs, what you're paying back to my investors per month that you're using our money. Okay, so it would benefit the borrower to get out of the deal or to successfully exit sooner rather than later, depending on the type of project you're doing. So basically each month, the loan amount, the initial loan amount, let's say I fund a $200,000 purchase price. So let's say we do, we fund 80% of that, so that's $160,000 initial loan amount on the purchase price. And let's say it needs 40K in renovations. So we've got a $200,000 loan amount. Okay. So $200,000 loan amount. And here I am again, I'll pull up my calculator because I'm still a calculator guy and will probably always be. So $200,000 loan amount times the rate, okay, not the points, but the rate is, we kind of started, we can go as low as 7.5% on the bridge product, but just for general terms with new borrowers, we're at 8.99. Okay, so let's take that $200,000 loan amount, multiply it by 0.0899, and then divide that by the 12-month term. And for a $200,000 loan amount, you're just looking at $1,498 per month. So right at about $1,500 a month that you're paying to borrow $200,000, right? So you don't have access to $200,000, but you've got 25K in liquidity, right? Let's say you've already paid your down payment. Well, now you've got to calculate, you've got to make sure if this project takes me 6 months to get out of, to complete the renovations, let's say 4 months, wrap everything up, get it on the market, and let's say it sells in 6 months, then what basically your holding cost would be that $1,500K times 6. So you've spent $9,000 throughout that time. So you've got to calculate those holding costs into your overall profit that you're going to get at the end. So again, it's kind of having a good timeline, good idea of your budget, and when you can successfully exit those deals. So did that kind of answer your question?
No, it did make a lot of sense.
I get a lot of bars are like, what am I going to pay? What's my monthly payment? I'm like, it's simple. It's a 12-month term. Okay. So whatever we're going to fund on the purchase price. So 80%, let's say 80% on the purchase price. We've got that number, then 100% of renovations. Now we add the two together, multiply that by the rate. We can use 8.99% for the rate. and then just divide it by 12. And that's going to basically be your monthly payments that you're making back. And a lot of people, you confuse it with PITI payments in the traditional world. And like, you got to use an amortization calculator, and, it just gets more complex, but this is simple math. But folks don't know what they don't know.
Yeah.
But you realize, it's pretty simple interest, and to get the numbers that you need, it's a quick calculation.
And so you have, I appreciate your customer service and your professionalism and how you do business. And so, we spoke a little bit about your family background and your journey as a professional athlete. What is your big reason why? What's your rich state of mind as to why you continue to do what you do? And you are very, very humble about it as well. So what is that big reason for you?
Man, I appreciate that. I don't know. It's just kind of been, I guess, a part of my DNA. So when I played football as an offensive lineman, right? So we're in the trenches, we're doing the dirty work for the greater good of our teammates. That, the pretty boys in the backfield, probably position you would play, running back or quarterback. But I was out there protecting you so that you could score and that you could win. And I think it's just a part of how I am. And I don't know why. We talked about it before the show, but I've got 3 girls. I was pretty much raised around a whole bunch of women, but here I am, was able to strap on that helmet and go, kick your butt up and down the field. So there was this emotional intelligence side of me and this empathetic side of me that was just caring and wanted to help people and see them succeed and just give as much as I could. And then there's also this relentless, tenacious, just ability to just want to get the win and celebrate each win and just get back to it. And so, all of that was a part of my life for 20 years straight. I think I missed probably 4 games throughout my career from injuries. Never quit a season, never missed practice. You had to drag me off the field in order for me not to play. And in college, I started all 4 years, and it was just how I was. I wanted to be in the trenches. I wanted to be out there. I wanted to be working. And that's just kind of how I am. I'm just a workhorse. And basically when I had, football ended and I had to hang up my cleats, there was a period, man. And, I'll be transparent and honest with you, of some serious depression and not knowing what to do with that anymore. And then basically, I think, when I realized my little girls were born, it wasn't about me anymore, so it was about what can I do to be the provider, because I had always had football and I'd always clung to it. And even football wasn't about me. It was about helping my teammates. But man, when you hang up them cleats, or, you're in the military and what have you, when you come home from that structure, that teamwork, and that dynamic into the real world, and it's just kind of not there. It's tough to get rid of. So, I think I had to find another purpose to basically live for, man. And that was my little girls. And then in this industry, just seeing other people win, man, and helping them with their investment projects, and, going to dinners, breaking bread with them, and sitting there listening and laughing about how much money they're making and how much fun they're having. It's really fun for me. So I can't tell you why, or it's just kind of a part of who I am. And I think sports and athleticism had a lot to do with that. And I think you'll, as you, even, with military background and what have you, there's a lot of companies that'll kind of just, recruit those particular types of individuals because they know what's ingrained in them. So I lean on that platform often, as much as I can. And then, a lot of God's favor too. So.
Awesome. Yeah. And you're right. Bryce, I really appreciate you taking the time this evening. This was definitely a special episode, because not only were we able to talk about hard money lending, which is the first time on this podcast, but I like the fact that you was able to be a teacher about it. You broke it down on what the process was. I try to break down the questions, or ask as many questions as somebody that is just coming in, just so they can have an understanding, because I think it's intimidating, right? Fast
Absolutely.
money, transactions happen very quick. You're
Absolutely.
talking about 7 days. I'm not going to lie. You give me 30, 45 days to close. That gives me a lot of time to raise a lot of capital, a lot of money. but if something's happened in 7 to 10 days, especially if I'm like already kind of shaky, you seem, your company, the way y'all do business seems to really, hey, look, we got you. Obviously, right, you got to have skin in the game and you got to kind of know what you're doing. But this is a collaborative effort and we are in here for both of us to win.
Right.
So definitely,
Yeah,
like investor friendly.
absolutely, man. Yeah. And again, I think that just comes, from me being a former athlete and being a rookie in the locker room. And, we stand on the shoulders of those who come before us and, leaning on some veterans or older guys and just being around some good coaches, because again, you reap what you sow. And eventually that borrower who may not be ready this month is going to come back in 6 to 12 months. And they're going to tell their buddies about you too. And, you're going to get referrals from it. So again, what you give will grow and what you keep, you will lose. So I think the more you can give, the more information you can help out, and the more you can be selfless. I don't have to sell anything. I'm not selling anything. I'm just being transparent, and I'm not a salesperson. I can't. I don't think I'm salesy at all. And I'll catch myself sometimes, like, even having to pause and tell some of my borrowers if I'm trying to sell something to them, I'm just like, I have to apologize and just let them know here's the facts and here's what's going on. And this is how we need to do it. And if you're not comfortable, what can I do to help you get comfortable? And then if we're not ready right now, let's wait till we are ready, because again, you don't want to shoot yourself in the foot, and especially on the first deal. So, man, I welcome all borrowers, man, brand new, curious, the most seasoned, best ones out there. I just want to help them all.
So I lost my train of thought because what I was thinking about was
you're thinking about finding deals right now. That's what you're thinking about.
Yeah.
But no, so I'll let you.
That's exactly what it is. And I'm trying to be
you're like
not
wanting
be
to get on your
selfish in this
computer
interview.
now.
Yeah.
Yeah.
No, I think this is a cool episode, man. And I do appreciate your transparency. And that's what I wanted to say. What I wanted to say was, we got to get your information on your company, how people can reach you and contact you, because what I really want to make sure the word gets out with you and with your business. So we'll make sure that we put your website, email, whatever way we can contact you in the description of this episode on the podcast and then on the YouTube version as well.
I appreciate that, my man. And if there's anything I can do to help you guys out, I most certainly will. And I'll dive more into y'all's podcast, and we'll continue to speak and grow together and help each other. And if there's anything I can do for you, I will, like I said. And maybe at some point end up sponsoring some of these podcasts too. If it helps you guys out financially in exchange for getting my name out there as well too. So that's the thing, man. There's plenty to eat out there, and so long as we all lean on each other and help each other, and get to the top of that mountain and turn around and reach back down and help each other up, man. That's what it's all about. So I appreciate it.
Thanks a lot, Bryce. Appreciate you.
Thank you, brother.